presentation is on investments, taxes, and real estate for high net worth individuals and families seeking global mobility. Now, with that, let's get straight into it. I do have to, of course, just share these disclosures with you. This does not constitute personal financial advice. You would do well to engage with an appropriately qualified cross-border financial planner such as myself or a CPA if you have tax matters. And everything presented here is believed to be sourced from accurate sources. I already have a chat, so that's remarkably early. Hi, Nancy. I did just want to mention that we have a YouTube channel where about 50 of my presentations are up. I've done many of them over the years, including income and capital gains taxes, Australia versus the US. That was the webinar that I did in September, and that's now up as well. Feel free to subscribe to the channel. It really helps, and certainly do so if you have an interest in the financial planning, tax, estate planning, investment management issues that affect Americans and Australians in America. Okay. So a little bit about me. I was really called to do what I do, working in this particular cross-border area. I was born a tri-citizen of the US, Australia, and the UK. And it wasn't until well, a couple things happened. I had just finished university. I had received a small inheritance and a settlement from a bike accident that I'd had when I was a child. And I went looking for a financial planner that might understand what these issues are between the two countries and how that would work, because I had, shortly after university, I moved to the US. And what I found was that there was nothing. There was no book, there was no resource, there was no group, there was nothing to help folks try and figure out how to live a cross-border life compliantly and take advantage of what opportunities there were between the two borders, because goodness knows it sure feels lucky to have access to these different countries. And sure enough, as I have spent the last 10 years looking into it, I've found that there are in fact many strategies for making the most of a cross-border life. I myself just moved back from Australia 2 months ago with my family, where we lived for 2.5 years, with the prior 17 before that having been in the US. So as I mentioned, I've had this business, Arete Wealth Strategists, for 10 years. We work with Australians in America and Americans in Australia to bring strategy, structure, clarity, compliance, and confidence to their global financial affairs and keep it that way. And you see the rest here. I won't bore you with that. So some examples of the kinds of clients, broadly speaking, that we work with, they would include the Australian business owner living in the US, a high net worth Aussie family currently living in the US, but considering their next steps in global mobility, and then the Australian executive family who has permanently relocated to the US. So these are all the types of clients and more that we work with. We work with retirees as well, but essentially we have a flat fee business model, or I should say a hybrid flat fee. So we're able to provide a guaranteed service level to clients. And then if they bring assets in excess of what is already included in that flat fee, then we charge a discounted asset under management fee for that. Okay, so tonight's presentation, I think you're going to find really enjoyable. I've packed in the gems that really affect folks, and it's going to be presented over 3 webinars. So there's going to be tonight focusing on investing, taxes, and real estate. The next webinar will be to do with the exit tax, the US exit tax, and estate planning and issues to consider with children. And the third session in December, I will have to tell you, I can't recall what that's about just off the top of my head, but it's continuing in this theme of the key points that we need to be aware of to maximize this cross-border global living. So the first concept I need to introduce tonight is source of income. What does that mean? Because it's profound and it has many ramifications. Next is investing and taxes. We can't really talk about that until we've been over source of income. Another topic to do with investing is number 3 there. That's what you can invest in as a US person abroad. And the key there is you want to avoid what are called PFICs, passive foreign investment companies. And I'll define that and how they're taxed and how one goes about being compliant with them. Next, we'll talk about real estate. Now, be clear, this is not a real estate update. There are plenty of other folks out there talking about the Australian real estate market and how it's slowing down, and yet there's signs of optimism in different markets. But generally, the rising interest rate environment is doing what it's intended to do, and that is slowing down price appreciation in the United States, and we're seeing the same thing in Australia as well. So we're going to be talking about broadly some things to do with real estate. So with that, let's move on and let's make it interactive. If you've made taken the time out to be here live tonight, then I'd love it if you could share your questions as we go along. If something's not clear, feel free to write it into the chat or the Q&A section, and I will address that in due course. Okay, first point here is the key concept is to do with source of income. So the source of income, this shouldn't be an alien concept to anyone that's owned investment property in the US where that property is in another state. So, excuse me, the concept being that the income is sourced to a different state. And it's the same principle we're seeing applied here. So the source of the income is to do with where the income is deemed to have come from. Where income is sourced from determines which country gets first taxing rights. So for US tax residents, determining whether any further tax is owed on the same income depends on a number of factors, but mostly it boils down to, is the federal tax rate that you're paying higher in Australia, which it almost certainly is, compared with the US? If it is, then the US will grant what's called a foreign tax credit for the tax paid and say, well, you would have owed us this much, which was less because the rates are lower in the US. You would have owed us this much. We see that you've paid more than that. We're going to treat the whole thing as a credit, and we'll give you a foreign tax credit carry forward. Unfortunately, it's very difficult to use those carry forwards, so they may end up expiring worthless, but nevertheless, that's the mechanism by how this operates. So if you're still domiciled in the US state, as you'll see in my example coming up, that could be a problem as well. For instance, if you're in California, as we'll see on the next slide, on a slide coming up, if you're in California, then that's a problem. If you have that rare Australian investment property that's actually producing a profit, which is extremely rare to begin with, but if you did, then not only would there be an assessment of taxation at the federal level, which I've already mentioned probably won't get you taxed, but what isn't granted a tax credit is at the state level. So you'd be paying state level tax on that as well, probably another 9.3 off to our friend Gavin Newsom. So how about capital gains? How are capital gains sourced? This is what I'm going to do in the coming slides here, is talk about how different types of income, capital gains, dividends, interest, and rents and royalties are sourced. What are the rules used for determining the source of these types of income? So capital gains is pretty straightforward. Of course, we can expand this to cover all manner of different intangible property types, but given that stocks and investment portfolio gains is what we're talking about here, it's an intangible asset, and it's sourced to the location of the owner of the intangible asset. So that means, in the example that I've got here, a client of ours living in Australia holds a portfolio of low basis US stocks. If they sell the stock, where is it taxed? Excuse me, excuse the typo there. Where is it taxed? It's taxed in Australia. And actually, it gets better than that, as I'm alluding to at the bottom of the page here. It gets better for Aussies, returning Aussies, non-resident aliens of the US, not US citizens and not permanent residents, because as I've discussed in practically every other presentation I've done, the US has what's called a citizenship-based taxation system, meaning if you're an American, if you're a citizen or permanent resident, and you go anywhere in the world, if you go to Antarctica, Zimbabwe, or anywhere in between, you're still a US tax resident. And as such, you'll be on the hook for assessment, not necessarily double taxation, but you'll be assessed to see whether any tax was owing to the US. So when that Aussie non-resident alien returns back to Australia, they actually get a step up in basis for assets acquired abroad. This can work very, very well for certain kinds of Australians. And I've seen this before with many clients who they go over, they may work for a number of years, get paid very well. Maybe they're given equity compensation in their companies. The stock does well, it zooms up, they make millions of dollars of profit. They move back to Australia, and I say to them, well, by the way, you get a step up in basis to the fair market value on the date you resume Australian tax residency. And we need to be very clear about when that is. We don't want to misreport the gains and get into complications on that side. But there is a gain, what gain there is stepped up to the fair market value. So assuming they sold it the next day with minimal gain, then they've essentially pulled a rabbit out of a hat and been able to take that low basis asset, low basis high gain, move to Australia, sell it, and not pay barely any capital gains tax on that. Is that fair? I'm not here to decide, but these are the rules. And the point of this slide overall is that capital gains are sourced to where the owner of that intangible asset is located. So you could easily flip the example, although it gets very complicated very quickly because of what's called Australian taxable property. Please take a look at the webinar that I did with Dylan Goldspring about a year ago, where we went into detail on Australian taxable property and how that works when one leaves Australia and what happens to the basis of that asset. Next, dividends. How are dividends sourced? Well, here is it straight from the horse's mouth. They're sourced to the payor's place of incorporation. So, in other words, where that bank or bond is it's actually where that company is located, where the company is incorporated. So another example to help illustrate the point: a client of ours living in the US owns an Australian stock portfolio that pays a dividend. Good problem to have. As the client lives in the US and Australia and the US have a tax treaty that provides for reduced withholding on dividends of 15%, this amount is withheld. 15% is withheld. Now, the good news is that the Australian company happens to conform with the definition of a qualified foreign corporation, and as such, the only tax due on it anyway was 15%. So what happens? Let's revisit that mechanism with the foreign tax credit again. Company pays dividend, Australia withholds 15%. IRS looks, the taxpayer reports that they received this dividend and also that the ATO withheld 15%. They report that on their Form 1040 when that's filed in the next year. And they say, well, looks like the ATO withheld 15%. The US does their assessment of what was due and owing, and they say, well, it was 15%. Looks like 15% was withheld. So all is good. The foreign tax credit equals the amount of tax that would have been collected anyway. This may sound like splitting hairs, what we're talking about here, but it is very important in the less common situations where things come up where, let's say, we're dealing with a company that's not a qualified foreign corporation in the US. And so people may think to themselves erroneously that dividends are taxed at 15%. It's actually not true. Only qualified dividends are taxed at 15%. So if you've got a foreign company that doesn't conform to that definition, then you're going to get taxed at ordinary income rates. But this is how it would work. You'd get Australia holding 15%, because that's what they do. That's per the tax treaty, that they do not get into definitions of qualified foreign corporations at that level. Then the US is going to say, I see, this is actually not a qualified dividend. We are going to tax you the difference between the foreign tax credit, the tax that's already been withheld, and the amount you would have owed had this been a non-qualified US company, in which case it would have been taxed at your marginal rate of income tax. Okay. Any questions or concerns? We've really only thus far been over capital gains and dividends. Given that this is the majority of what I see, I wanted to provide examples here tonight and go through it really slowly in case anyone was confused about this. So just to revisit, capital gains is sourced to where you are. Dividends are sourced to where the company you're investing in is registered. Okay. No questions. That's great. Let's keep going. Okay. What about the sourcing of interest, personal services, and rents and royalties? So this is pretty straightforward. I don't think we need examples because they're honestly they're self-evident. But if it's unsure to you, then do feel free to write in. So interest is sourced to the payor's residence, meaning where the bank or bond is located, paying the interest in the first place. So let's run a quick example there. You're in Australia, you've got some money in a US bank account. It's earning, if you've structured it well, it should be earning about 5% right now. It's earning 5%. You report that on your tax return in Australia, and the source of that income is going to be deemed to be foreign. And there may be withholding on that in the US, depending on your nationality and your US legal status. Personal services, what's that mean? That means employment-related income. So if you're working for a US company, the proper taxation it's the source of the income is deemed to be where the services are performed. I see this all the time, and I've actually taken to having a shorthand answer for it. And that is, I'll get asked by clients, hey, I've got a great job in the US. I'm thinking about moving back to Australia. And here's what I'm thinking of doing. I'll just stay on US payroll. I'll get paid in US dollars. They'll contribute to my 401k. It's going to be great. And I say, oh my goodness, look, I can tell you what the situation is. Your HR department or payroll department haven't seen this before. They don't know the headache that they could be causing themselves. And what ends up happening is 1 year goes by or less, HR or payroll or whoever it is in the accounting department get wind of this source rule that you see right here. And they say, oh my God, you're telling me for one employee, we have got to set them up on Australian payroll. We've got to open up a superannuation account. We've got to be completely localized for that one individual. So the number of times that I've seen these long-term employee expatriation situations work out is exactly zero, with one exception. That was a global consulting firm where they knew exactly what they were doing going into it. And they had someone who's extremely well paid with very, very valuable source of knowledge in her head, and they let that go through because that was what they were planning on doing. Okay, rents and royalties. This is very, very straightforward. It's sourced to the place of use of the asset. So let's say you've got an Australian investment property owned by a US tax resident. The rent is US tax resident located in the US. The rent is received in Australia and paid to the owner in the US. Of course, it's Australian sourced. Why? Because real estate is very clearly located in that country where it is physically present. Okay, source of income, some other pointers to be mindful of here. Clients need to be careful to avoid other negative tax outcomes. So with foreign source income, a client may be forced to spend time and money filing foreign tax returns when mandatory withholding isn't sufficient. And not the only example of this may be real estate. Real estate is the example that comes to mind, but there could be other examples. For instance, the non-qualified dividend that I was talking about earlier. That could be something where there was insufficient tax withheld at source, and it could cause a problem. Different tax rates might apply to what would otherwise attract preferential tax treatment. For instance, real estate income from Australia. In Australia, you're going to be taxed at the resident rate. You can see over here, I've got the red circle of bad financial outcomes centered over the non-resident tax rates. And that's because if you're in Australia, you possibly have the ability to take depreciation. you had the ability to be taxed at the residence rate. You even have the ability still to negatively gear that property, which means essentially your expenses exceed the income received, and you can take a tax deduction against your ordinary income, something that has been outlawed in the US for the past almost 40 years, where they separate out the different types of income to be earned income and passive income, and a passive loss can only be offset by a passive gain. But in any case, I digress. So now what the point here of the second bullet point is, you've just taken income that could have been taxed at one level and you've put it into one of the worst tax regimes out there, and that's the Australian non-resident tax rate. You've also got differences in timing and the recognition of income between different tax years, which makes reporting rather difficult. And then difference in tax laws can affect taxation and expected returns. So for instance, if you were to purchase anything other than new real estate in Australia, there's no depreciation available on that, compared with in the US, where you do get depreciation. So it just makes me think that real estate investing should really be approached from the same perspective as estate planning in this regard, and that is you need to think that you have for estate planning, the idea is that you have a separate will in each country for where you have assets that don't otherwise pass directly to trusts or transfer directly by a TOD, transfer on death instruction, or a joint title. And it seems to me that it's the same with real estate. You need to be very mindful of what you hold overseas, because there's other things that can come up. There's estate taxes that can come up, and it can just be a real nightmare. Okay, moving on. And here's the example I was alluding to earlier to do with the source of income. So a mixed nationality couple, that actually has a very precise definition in international cross-planning. It does not mean people, necessarily. Very likely it would be from different countries, but the point of this term mixed nationality is you've got one US tax resident and one non-US tax resident. So they're living, a couple living in California own an Australian investment property. As real estate is considered source to the country where the property is located, we know that this property is going to be Australian sourced income. Thus, Australia will get first taxing rights on it. But as the couple are primary US tax residents, and the US taxes worldwide income just as Australia does, and most other developed countries also do when you're a tax resident, the income will need to be included in their US and California state tax filings to determine whether any additional tax is owed. So California income tax will be due on this income as the couple are domiciled there. That's not the case necessarily in other states if you're not physically present. In California, if you did what my family did, you moved to Australia for 2.5 years, let's say, but you intended on returning, that income would still be taxable in California while you were overseas. In Minnesota, it happens they don't have that domicile rule, so that doesn't apply here. There very likely wouldn't be additional US federal tax owed on this income, as the Australian rates, as I mentioned earlier, are so much higher than the US domestic rates. So let's move on then to passive foreign investment companies and see what we have here for you. Again, any questions, feel free to jump in and ask. Okay, so PFICs. What is a PFICs, first of all? This may be the first time you've ever heard of it, but I'm so glad that you've tuned into this, because it could save you an enormous amount of time and hassle, stress, and tax as well. So simply put, a PFIC, a passive foreign investment company, is a non-US investment vehicle meaning it could be a company, it could be a managed fund, it could be an ETF, it could be a REIT, a real estate investment trust, could be a listed investment company that generates most of its income from passive investment sources such as dividends, interest rents, royalties, and capital gains. Thus, we have the PFIC test. What is the PFIC test? Not to bore anyone here, but that's the test there, the income test, the asset test. So essentially the way that this regulation was written was intended. It was intended to be so broad as to capture all foreign managed investment products out there. Thus, if you have an Australian or any other country, Japanese, Chinese, European, Canadian, managed fund, ETF, money market fund, real estate fund, listed investment company, and certain superannuation funds, definitely including self-managed super funds, then you have a PFIC. Stay tuned. What does that mean if you have a PFIC? I've got this article taken from Hodge and Law, as you can see here, and he's essentially saying exactly the same thing as me. It was written a dozen years ago, but updated just a few months ago. And he's saying exactly what I'm saying, but actually the point for why I took this screenshot was to show you the amount of time that is estimated to comply with having a PFIC, because this is one of the very, very few areas where the PFIC taxes, depending on the amount of a foreign investment you own, the PFIC taxes may not be that bad. They may merely be in the thousands of dollars. I've seen hundreds of thousands of dollars before. They may merely be in the thousands, but often the worst part is the amount of time it takes to even be in compliance. And if you don't want to do it yourself, you're paying a CPA very handsomely, depending on the number of PFICs you have. So the estimate that we come up with here is over 30 hours, 31 hours, 29 minutes for a PFIC. And this guy's a tax attorney, I might add. So he probably has some familiarity with it. All right. So what are the tax consequences? Let's go into that. And this is going in a descending order of penalty. So the worst is the do nothing. This is if you don't even know you have a PFIC, that's when you get hit the hardest. And the way this works is there's a penalty for investing in a PFIC that produces excess distributions, and that's defined. That's a term that's defined, but basically it means if it pays a dividend, it has to be there's a formula for how it works. It's 125% of the prior 3-year average. So if your dividend is increasing at all, then you have got yourself a Section 1291 PFIC, and it's going to be taxed at the highest marginal rate that existed, not your highest marginal rate, the highest marginal rate for every year that you held the PFIC. Once a PFIC, always a PFIC. You cannot change the status once you've got it, other than just to sell it, pay the tax, and be done. Next, we've got annual mark-to-market, which is pretty bad because what this does is it takes what would otherwise be a capital gain. You could hold for long-term capital gains treatment and sell it, possibly paying just 15%, 0% if you're in that particular tax bracket for some, and as high as 20% plus the net investment income tax of 3.8% as well. But that's the mark-to-market. So every December 31st, you need to look back and see what gain you had throughout the year, and whether you sold the position or not, that's what you're going to be paying at ordinary income rates. So that's really no good, and it's especially no good for higher income earners who may already be in a 37% federal bracket. The last, and it's almost something I think about not including. Someone, I'm sure, would pull me up on it and they'd say, hey, Ashley, what about the qualifying electing fund treatment? Which is why I put it in here. This is the third option. Now, if you happen to have a PFIC that conforms to this, then you're in the clear, because they do generally get the same treatment as a domestic fund. But here's the kicker. I've never seen a QEF Australian side. Not once, never seen it. Canada, yes. Europe, yes, but very rare and somewhat expensive. So you might not want to invest in them anyway, given their cost, their rarity, and otherwise unattractive returns. But nevertheless, you do avoid qualifying electing fund treatment. So how do you avoid PFIC status? It's all well and good that I've said don't do this, but I believe in providing answers as well. And the way to do that is simply to own with what you must own in Australia, you want to own that in individual stocks and bonds. So that means instead of buying an ETF that includes insurance companies, mining companies, and telcos, you go and buy QBE, you go and buy Wesfarmers, you go and buy Telstra, or whatever the case may be. So you own those stocks directly because the individual stocks do not fall foul of that PFIC definition. All right, real estate. This is always a crowd pleaser. People show up in the hundreds when we get talking about real estate. But here's the thing, is it's not all good news. In fact, there's very little good news when we're talking about this in a cross-border context. So I'm going to start by talking about the things to consider for anyone buying real estate overseas. It doesn't matter if you're an Australian, American, or European, you're going to be dealing with foreign tax filings. So there's time and money involved there. You've got foreign exchange fluctuations. So you may have a mortgage that's denominated in a foreign currency. You've got rent in a foreign currency. You've got property management issues. Can you even rent the place out? Are the tenants giving you trouble? There's estate planning issues, as I alluded to earlier. There was I kind of had that thought as I was talking, to do with real estate and estate planning issues have a lot in common, or a lot of the same issues come up when thinking of foreign real estate and the consequent estate planning issues. There's what's called ancillary probate that may be involved if it's not owned by a trust. And guess what? You're damned if you do, damned if you don't. If it is owned by a trust, what might the property be deemed? Let's go back just a couple of slides. It would be deemed a PFIC if you're an American owning real estate abroad inside of a trust that helps you with estate planning, doesn't help you with tax. And then there's changes in law that happen. What about if you're thinking about buying real estate overseas as an American? So let's add another filter to that. Well, we've got to be mindful, of course, of the savings clause. That's the shortcut way of saying that any American anywhere outside of the US is always a US tax resident. The savings clause is a clause written into each treaty that the US income tax treaty the US has entered into that says, if you're an American, we're going to pretend as if this treaty doesn't, and any treaty benefit just doesn't even apply to you. We're saving domestic treatment for you. That's what the savings clause means. So don't forget about that. That's really going to hit you with capital gains. If you have a significant capital gain on the property, remember, you may have concessional tax treatment in the country that you're in, but Uncle Sam wants to be paid and there may be no such concession treatment. US citizenship-based taxation applies to you. Yeah, that's the point of the savings clause. FATCA may also apply to you. That's the Foreign Account Transaction Compliance Act that came into effect in 2011. It's another reporting obligation that affects Americans abroad, and depending on your tax filing status, depending on the amount of your assets, is going to determine whether that's necessary to be filed. Okay, things to consider when buying real estate overseas as an American with a non-citizen spouse. Might you unwittingly be bringing your spouse into the US tax system? Now, the reference here is to, I believe it was December 2021, when I spoke about mixed nationality couples. I did a webinar that you can find on YouTube to do with what's called a 6013G election. And that's a once in a lifetime opportunity to bring your spouse into the US tax system so that you can enjoy the married filing joint tax status. That's really going to be helpful when you've got the American spouse as the breadwinner. That's the primary situation that I could see that making sense. Alternatively, we're going to see this happen when people didn't know what they were doing. They've stepped into it and they've stepped on a landmine, because if you did know what you're doing, you would put the real estate into the name of the Australian individual and thus avoid all this nonsense with the US in the first place. And that's a great example to the second bullet point here, where are you foregoing the unlimited primary residence exemption? Let's say you hold your residence in joint title. It's appreciated enormously as real estate is done in Australia in the past decade in particular. and certainly the last 20 years, it's appreciated enormously. Well, bad news if you hold that property in joint title, because Australia will give the spouse, the Australian spouse, an unlimited primary residence exemption on that gain, assuming so I shouldn't need to make this qualification, but it's a primary residence, therefore it's an Australian primary residence, therefore it's in Australia, therefore the couple are both primary Australian tax residents. But don't forget, Uncle Sam is there with his hand out, wants to get paid. That other spouse is having to file, unless they've made that election I mentioned a minute ago, married filing separate, and also they do get a primary residence exemption, but it's only for $250,000 US, and then above that, capital gains would be due. So bad news. Okay, what are some other things? Well, the main residence exemption, as it's called in Australia, that went away about 3 years ago if you move overseas, so that's no good. Another thing that's no good too is for property that was purchased after May 9th of 2012, all gain that occurs while you're a non-resident is taxed at non-resident rates. And I feel like it's worthy of going back there for people just to realize the magnitude of what I'm saying. This is huge. I'm going to go back several slides, which is why I'm bringing it out of presentation view. I am looking for, here we are, looking for this. I wanted to show you this point to do with the non-resident tax rate. So in other words, you've just taken an asset that, had you held it as a resident, you would have been taxed half of these rates here, 19, 32.5, 37, 45, long-term capital gains rates for a resident Australian investor. If you're owning an investment property from overseas, congratulations, you've got, let's say you have $1 million gain on that. Look what you just did. You're now paying 45% at the capital gains rate. Questions come in from Heather. Hi, Heather. Thank you for the question. Can you transfer the title of Australian property to the Australian spouse? Oh, I knew someone would ask this one. And I do happen to know the answer. I know the answer with confidence in Western Australia because I've just had a client who's gone through this. And it does vary, Heather, on a state-by-state basis. But bad news, in Western Australia, it's a dutiable, it's quite a fun word, that one, dutiable event to change title, to do what you're describing. So that would mean stamp duty and other fees would be associated with that. I know that's the case in Western Australia. I'm not certain that it is otherwhere. In other states, you would need to call your state office that deals with that level of taxation and inquire with them. I'm just going to go back to where I was in the presentation. So 1 second here. We're looking at this wallet being clamped. Okay, just loading that back up. So the point I was making there is that if you own Australian investment property and you're a non-resident, you've just moved the gain of that into a 45% bracket where it could have been half of those rates. Other issues, this is sort of a potpourri of other issues that come up for non-resident real estate investors. You've got higher land tax rates for absentee owners in Queensland and also New South Wales, as I recently learnt for a client who was asking about buying real estate in New South Wales. Even though she's physically present in Australia, she is not an Australian tax resident and doesn't want to be for various other reasons. But in any case, I said, no, you don't want to do that. And in fact, that's where this came up that you see right here. I'll come back to that ghost house in a second. Higher stamp duty and land tax for non-residents in New South Wales and Victoria. So this is verbatim from New South Wales. Non-residents must pay a surcharge, purchaser duty of 8% of the dutiable value. There's that word again. The greater of the purchase price or value of the property. In addition, there are the words there, to the standard stamp duty payable on the acquisition. Non-residents must also pay a surcharge land tax of 2% of the taxable value of the land that's due every year. So there's in the US, by the way, it's typically about 1.3%, and people complain about property taxes. This this is one of these things where I feel like I'm the lone voice. Like there's me and a couple other financial planners that know that, and tax CPAs as well, that know this, and we're up against this behemoth industry of real estate spruikers constantly talking about why non-residents should own Australian investment property, and they always ignore these points without fail. And that's why I just think it's a dog of an asset. Heather, thanks again. New South Wales allows transfers, but have to pay standard. So actually, I'm sorry if I was unclear on my answer. They all allow the transfer, but if you're talking about transferring $1 million property, that could be $80,000 in stamp duty and possible capital gains too, in order to actually affect that transfer. Is it possible this would be considered a sale to the US? Yes, it is. That's my understanding, is that it is considered a sale. It's not gifted, it's not retitled, because, and as we did, Heather, I'm not sure if you were watching my webinars a year ago. I don't think so, but if you were, you'll recall I did a whole series with Dylan Goldspring, who's a cross-border CPA, on exactly this point. The way the gift system works between Australia and the US is fundamentally different. Australia doesn't have a gift system, just flat out doesn't have it. Anytime there's a transfer from one individual to another, it's a dutiable assessment. It is a capital event. So even from spouse to spouse, that can also be the case. In the US, they have this beautiful concept called the unlimited marital transfer. So there's no gift tax that's assessed, assuming you're dealing with two US citizens gifting between each other. If it's a permanent resident if it's a citizen to a permanent resident, there's an annual limit of $179,000. Otherwise, it eats into your lifetime gift exemption. So bad news, unfortunately, Heather. Jen, good to see you, Jen. Those recent changes also apply to Australian citizens who sell their Australian principal residence while a tax citizen of US. So go from 0 to 45% on every dollar of gain from purchase price. You can no longer get a valuation to set cost base when you depart Australia. I'm not sure if you've written that as a question or a statement. To be honest with you, yeah, exactly, Heather. I'm a little rusty statement. Okay, well, that kind of clarifies it. Then I was about to say, Jen, that I'm a little rusty on that main residence exemption and whether there was some sort of grandfathering. There was a 6-year rule in effect, but I think that went away in 2020. That's what it was all about. So yeah, it's horrible. And like I was beginning to say, it's me and a couple other planners and CPAs that know this, that we're trying to overturn the tidal wave of mortgage brokers, real estate spruikers, and everyone else that's on this bandwagon of go buy Australian real estate, when it's about the worst financial decision that you could make, I think, in specific circumstances, with a little asterisk to hedge exceptions that may apply to that. What would be an exception? I've got some coming up, actually, in just a moment. So if a non-resident purchases a residential investment property in New South Wales for $1 million, this is just running with the example from the prior slide, they'd pay the following taxes. They've got your regular stamp duty. There's your 5.1%. There's your surcharge purchaser duty. Oh, there's your 8%. So there's another 80 grand. There's total stamp duty of $131,000. They're also required to pay land tax on the property each year, which is an additional 2%. By the way, it is rare enough as it is to see a cash flow positive property. That's financial advisor speak for the rents exceed the expenses of the property. Almost never happens. Certainly less common in this higher interest rate environment that we're seeing, but it was rare even when interest rates were next to zero anyway. To throw a 2% tax on the whole property value on top of that, yeah, it's going to be very rare indeed to find a cash flow positive property. So pros and cons of holding Australian real estate as an American resident. Let's run through this. So regular inflation indexed income. Yes. Okay. Yep. That may be the case. if you're lucky enough to have cash flow positive property, which you probably aren't. So we could put a cross. I'm going to move to editing mode because I'd say in reality, you're really not going to see that. That's as rare as hen's teeth. So we can forget about that one. I just can't find the strike through right at the at the moment that you want it. I can't see where I could put a strike through. But let's strike through that. So forget about that one. Capital gains potential, that's still true, but you've foregone potentially, if you're not in Australia, you're going to be taxed non-resident. So that's bad news. And if you're an American in Australia and you hold that title to that property, you're going to be paying the higher of the Australian or the American tax rate on that capital gain. And more often, this is actually one of the few times this happens, more often it can actually be the US side that ends up being causing a headache. Okay, concessional long-term capital gains tax rates, we know that doesn't apply because as of what I just said. Buying power buying prior to moving is one way to hedge against a major price increase. Yes, but remember what happens to your tax treatment for any gain that occurs while you're a non-resident. Tax at non-resident rates may possibly employ negative gearing once you assume Australian residency. Now that I had to reach deep into my bag of tricks to even think of that. I mean, yes, it's true, but it's like it's barely any salve for the insult that's already been incurred here. Now, what about the cons? The list here is quite a bit longer. Very rare, if not impossible, never say never, but very rare to find a cash flow positive property. It's more likely going to cost you money to own it, and thus it becomes analogous to what's called a call option. So you own this thing that costs you money. The only way you ever actually make money on it is if it happens to increase in price. In today's environment with the interest rates as they are, that is not a guarantee. That's anything but guarantee. A range of punitive taxes, let's change penalty. They're not exactly penalties, but punitive taxes that apply while you're a non-resident that we just went over a minute ago. Australian sourced income, thus you've got to file an Australian tax return, deal with property management in Australia and all the rest of it. You've got 2 holding periods to calculate. Should you sell the property, the time when you were a non-resident and the time you were an Australian tax resident. You got foreign exchange hassles, property management hassles. It's illiquid. You can't just sell it like a stock. You go to the exchange where, by the way, the transaction costs, which is coming up next, trading costs. Does anyone know what's the trading fee right now to sell a stock or an ETF in the US? What does that cost? Is it 5% of the stock value, or 6%, like it is for real estate? No, it's actually 0. It costs you nothing. With Charles Schwab and a number of other brokers in the US, it's exactly 0. There's a price war that was kicked off in 2019 by Schwab, and it's 0 to sell that. Whereas in Australia, you're looking at a couple percent, 2 to 3%. In realtor fees in the US, it's more like 6%, with some of the highest realtor charges in the whole world. There's a reason there's practically no market for foreign REITs after all of that. Okay, when might it make sense? And even then, these mightn't make sense. Jen, with your statement here earlier, I feel I have to qualify one of these points here. So I like to differentiate between a use asset versus an investment asset. And I think it might make sense as a use asset, meaning you're going to live in it, you're going to use it. Whereas an investment property, by definition, is an investment asset, or a stock is an you don't really use a stock unless it's a closely held business that you happen to enjoy some product or service that it produces. That's a very obscure example, however. Do you plan on moving into it at some point? Well, you might, and the gain from at the point at which you do move in would be taxed at the resident rate, but the gain before that, non-resident. Will the property be at worst cash flow neutral? Not likely, probably going to be a loser. Might you become an Australian tax resident at some point in the future? if you have, and I should probably add that there, if you have a long-term holding period in mind, then it would make sense. Okay, that really wraps it up for what I had here today. If you are interested in learning more or speaking, feel free to come to my website, click on the Get Started, fill out a brief questionnaire, and then find a time and we can talk. Next month, as I mentioned, so coming up on November 21st, we've got the US exit tax and issues relating to children for high net worth individuals and families seeking global mobility. So there you go. We'll be talking about issues affecting the children of the globally mobile and estate planning. If you're looking for these videos or any blog posts or flowcharts or white papers, you can find that also under the Knowledge Center. You can also download your key financial data sheet. And that brings us to questions and answers, in which case we are here with Heather. Thank you very much. I appreciate the comment. I appreciate the praise. I do enjoy, as you can tell, this is, I describe this as my calling. There's some other viewers on here tonight who've known me for a long time, would know that I'm a natural educator and have a passion for this. But anyway, enough of that. Are there any other questions, concerns, doubtful points, anything else anyone has here tonight? Don't be shy. Now is your turn to ask. I can imagine people are busy typing away feverishly on their keyboard. Tom, you still got your hand up, but I think you put your hand up from earlier, so I'm going to lower your hand. Anyone else? All right, I'm going to say that was about time. Thank you, Jen. Appreciate that. You're doing your estate planning now. Perfect. Appreciate the praise, and I look forward to hopefully seeing you here next month, just before Thanksgiving for those of us here in the US. And otherwise, have a wonderful rest of your evening or day, depending on where you are. Thank you so much.